we have covered so far this IAS 37 provision. We understood the basics. We also discussed about the calculation of provision and the finance cost and opening provision plus finance cost gives you closing provision and so on. Now, this is a topic which is also very popular. It is called provision for restructuring. And here you are not required to perform any calculations. You are only required to answer it academically, theoretically, or to apply it to certain situation. Now, you should remember that we have been discussing sometime that, sometimes there are some manipulation with accounts, management probably tries to manipulate or maneuver some, profitability. And one of the possible areas is for provision for restructuring. Now, provision is something when you are debiting your P&L and you are actually crediting your SOFP, statement of financial position, by charging some provision. So it gives you an opportunity to take something to P&L. And whenever you are taking something to P&L or taking something to SOFP, you need to be careful. So, and by the way, these are not the real incurred expenses in the current period. These are something which may happen in future. So based on future, you are making estimate and you are charging it now. Okay. So this, when something can happen in future and you are estimating, there is a possibility that either you make an error in your estimate, or you do some kind of manipulation about future. Okay. Like if I receive an invoice for $1,000, it is $1,000. I already have this invoice. There is no error and there is no manipulation. But if I say that, there is some particular event which would cost me $5,000, and I say it will cost me $5,000, I might say it might cost me $6,000 because that's an estimate. There is no invoice for that. There is no document for that. So provision is something which you are assuming a number for the future. And when you are assuming a number for the future, you might make an error, a mistake in your estimation, or you might be doing some kind of manipulation. So therefore, you need to be very clear and very careful about, when you create provision. So idea here comes for provision for restructuring. What is restructuring? We all understand restructuring of organization, okay? So sometimes it is possible that you have an organization and you are planning to restructure it in the future. You want to do some restructuring. The question is that this restructuring will take place probably in future, sometime here. Should we create a provision for this or not? Should we create a provision for this or not? Now, the first thing, and by the way, when you create a provision for that, it is definitely going to impact P&L and SOFP. So you should be careful that restructuring provision is allowed or not. That's a very hot topic because this is one area which gives you a lot of opportunity to do manipulation. Okay, now the first thing which you need to understand that what is a provision. You remember that we said that provision is an uncertain liability. So provision you create against some obligation. You create against some liability, but uncertain liability, but liability is there, obligation is there. So the first thing is that doing the restructuring in our company, is it an example of a liability or an obligation? Is it our obligation? Just like if you remember that in previous lesson, I said that if you are doing some overhaul of your equipment, overhaul of your machinery, sometimes they call it major overhaul or they call it overhaul. I said don't create provision because that is not an obligation. Repairing your equipment or overhauling your equipment is not your liability. Liability is something which goes out of the entity, economic benefit, and it is legally, you are legally required. In this particular case, you are not legally bound. Maybe you know that you have to do some overhaul of $2 million in 2 years' time or 3 years' time. But it's not an obligation because at the end of 3 years, you might decide I will not do overhaul, or you might decide I will stop this equipment or I will sell this equipment. In any case, nobody can force you. Nobody can take you to the court to make it happen. So therefore, it is not an obligation and it is not a provision. So we don't create provision here. Now, if I apply the same logic here about restructuring, we have a company and we are planning to restructure our business. Now, what is restructuring? That is also very important because we will learn it today that according to IAS 37, what falls under restructuring and what does not fall under restructuring. So let's suppose that we talk about restructuring. So let's suppose it is restructuring. Do we have an obligation on that or not? Can somebody force it? Can somebody push it? It is restructuring. I want to change the scope of my business. I want to do some restructuring in my business. Is it an obligation from outside? The answer here is that you might not have a legal obligation. You might not have a legal obligation. But you do have a constructive obligation. You might have a constructive obligation. Constructive obligation means that it is not a contractual obligation, but because of my past actions or my behavior or my communication, I have created some expectations for other people. I've created some expectation for other people. So if you are thinking of restructuring your organization, and if you have conveyed this message to the concerned parties, they might have developed some kind of expectations. And therefore, it has become your obligation now. We call it constructive obligation. Now, as a constructive obligation, I give you one example, a real life example. I won't give the name of the company, but I'll tell you the facts. So a company used to give bonuses to its staff. So it gave bonus every year to its staff, for many, many, many years. And by the way, that's a government organization, not a company. So a government organization used to give bonuses to its employees historically for the last 10, 15, 20 years. And then suddenly on one fine day, they say that this year there will be no bonus. They say there will be no bonus. Our contractual salaries we are giving, whatever is written in the contract does not say any bonuses. So we are not giving you any bonus this year. The employees of that government organization, they took the organization to the court, and the court decided that they should give bonus. The court decided that you should give bonus because you have a constructive obligation. You have created a constructive obligation. People for the last 10, 15, 20 years, they have become used to the new employees who come in, because you might be giving salaries which are less. You might be giving salaries which are less, but people, they accept these salaries because they know that end of the year, they will get some extra money because they're expecting this money. Based on that, they're expecting these salaries. And based on this expectation, they have, made their own commitments. Somebody has taken a loan, somebody has done some other thing that I will get bonus and I will pay from there. Because from your past behavior over last so many years, you have created or developed this expectation. And therefore, now it is a constructive obligation. You must follow it. So obligation, when I say, what I mean to convey here, that when I say obligation, it does not necessarily mean that you should have a contractual legal obligation. There are constructive obligations as well. And the restructuring, it falls under constructive obligation. Constructive obligation, it falls. I mean, when I convey this message that, next year we are going to make these changes, many people, somebody might be thinking of leaving the company now or leaving the job now, but based on my communication with them, they might change their mind. They think, oh, the company is going to make some changes next year, so I should stay in the company. Maybe I will get progress, maybe I will get promotion. And they had some job offer, which they rejected. So after 6 months, then you come and say, no, we are not moving. So that's not fair. There is some constructive obligation part there. So anyways, we see provision for restructuring. So first we need to understand what is. The restructuring is a planned program. So it is something which has to be well thought, and it is a planned program which materially changes the scope of business undertaken by an entity or the manner in which that business is conducted. So two things, either the scope of the business, so which means that whatever you are doing before, you added some more things. For example, you were a construction company and you were constructing some, how to say, residential properties, and then you also start maintenance of the residential properties. One is construction of residential properties and one is maintenance of residential properties. When you move from here to here, you are changing the scope of the business. You are adding one new major line or the manner in which that business is conducted. You are not changing the scope. Scope is same, but the way job is done, that has changed. Probably you were an educational institute which used to provide physical classes. Now you have decided to go online. So work is same. You are doing the same job, but the manner you have changed, the method you have changed. Now you have moved it to online, banks moving online banking and stuff like that. So restructuring means that one of these two things should be there. A provision for restructuring cost is recognized only when the entity has a constructive obligation to restructure. When you have a constructive obligation, and how that constructive obligation will arise, it will arise from your communication, from your information which you share with others, and you communicate the message. If you are just changing the positions of few people, that is not restructuring. Remember, restructuring is not like this, that, okay, X from now you will sit here and you will sit there. It is not restructuring. You are changing your office environment. It is not restructuring. Restructuring has to be these two things, scope or manner. Yeah, if you are making some big management changes, you are removing the layers of management, that comes in restructuring. If you are closing your operations in one particular country, that is restructuring. Like you are a bank and you are operating in one country and you might have, I don't know, 50 branches. You close this branch, you close this branch, you say, oh, this branch is not performing well, let's close these 3 branches. It's not restructuring. Restructuring is when your operations stop in a particular geographical area. Not like one branch I add or one branch I reduce. It is not restructuring. So when you have a constructive obligation, this will only be where an entity has a detailed formal plan for the restructuring. So you should remember the word, it should be detailed and it should be formal plan. And has raised a valid expectation in those affected that it will carry out the restructuring. Maybe your customers, maybe your suppliers have developed some expectations. Your customers have developed some expectations because of this detailed plan. And this plan has been communicated. A restructuring provision should only include, not only that you have a plan, actually the communication of this plan is, so restructuring is not mere, we say that it is not, let me write down like this, restructuring is not a mere management decision. This is exact wording in the standard, a mere management decision, which means that it is not like the senior managers have thought about it. No, it must be, it has been presented to the board, it has been approved by the board, it has been communicated to the related parties. So it's not just like one person's thought. There is a proper, formal, detailed plan which has been approved by the management and the board and which has been communicated. That comes under restructuring. So a restructuring provision should only include direct expenditure arising from the restructuring direct expenditure, and necessarily entailed by the restructuring, which means that it is a result of restructuring, it is necessary for restructuring, not associated with the ongoing activities of the entity. And a restructuring provision does not include retraining the staff or relocating the existing staff. So many times in exam question or in situation, they will show you that, a company has a restructuring plan where they have allocated $2 million for retraining, $1 million for relocating, excluded because it does not include retraining. Relocating does not include. Marketing is not included. Investment in new systems. After restructuring, you will have investment in new systems and distribution networks. They are also not included. So these are the things which are not included in restructuring. There is a short question. On 12th December 2020, the board of an entity decided to close down a division. Now it's not like closing down a branch, it is a closing down of a division. A full line of business is being closed. Explain the appropriate accounting treatment, assuming that no steps were taken to implement the decision and the decision was not communicated to any of those affected by the end of reporting period 31st December. So no formal steps have been taken to communicate it and no implementation steps. Second situation, if a detailed plan had been agreed by the board, letters sent to notify customers and the staff of the division have received redundancy notices. By the way, redundancy call is restructuring call. When you restructure, maybe you are closing down, redundancy costs are within restructuring. Okay. So now these are the two situations. Number one, there has been no obligating event because there was a plan, but it was not formally agreed and it was not formally communicated. There is no obligating event and therefore no provision. If somebody's mic is on, please, Rajesh, you need to mute yourself. In the second instance, which you will see, the communication of the decision to the customers and employers give rise, because you already have communicated, it give rise to constructive obligation because it creates valid expectations, and therefore you should have a restructuring provision here. Okay, this is all. This was the last part of this IAS 37 contingent assets and liabilities provisions. For restructuring, you might be getting a short question, separate 2-3 marks. What is a restructuring provision? And you should explain like this. Or you might get some numbers. Within a long question, there is a long question. And within part of that long question, they will say that note 5, a company has a restructuring program, blah, blah, blah. And there are some expenses which they assume 5 million, 2 million, I don't know, 1 million, and total 9 million, they are 8 million, they have allocated for provision for restructuring. And you need to justify that whether they should include in the restructuring provision or not, they should include it or not, they should include it or not. This type of question you can expect in exam from restructuring provision.